Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Navigating European growth and shifting trade dynamic. The Pan-European Stocks Europe 600 index closed last week 0.77% higher in local currency terms, a performance underpinned by resilient economic data and robust corporate earnings. Despite the positive aggregate movement, regional performance remained fragmented across the continent. While Germany's DAX and Italy's FTSE/MIB recorded modest gains and the UK's FTSE 100 outperformed with a 1.09% increase, France's CAC 40 index diverged from the trend, posting a 1.23% loss. In a pivotal shift for the Eurozone's largest economy, Germany successfully exited a two-year recessionary period in 2025. This recovery was primarily fueled by intensified domestic demand, with both household and government spending driving a 0.2% GDP expansion for the fourth quarter and the full year. However, the nation's export-led model faced significant headwinds. Higher U.S. tariffs, a strengthening euro, and increased competition from China led to a 0.3% decline in exports. Concurrently, imports rose by a price-adjusted 3.6% following 2 years of contraction. As a result, Germany's trade surplus narrowed significantly to 110 billion euros, down from 241 billion euros in 2024, marking one of its lowest levels in over 2 decades. The UK economy also demonstrated a return to growth, with GDP expanding 0.3% sequentially in November. This figure exceeded consensus expectations of 0.1% and followed 2 months of contraction. The recovery was broad-based, supported by expansions in both the services and production sectors. Within manufacturing, output was notably bolstered by the resumption of operations at Jaguar Land Rover facilities following a disruptive cyber attack. Broader euro area industrial production continued its upward trajectory, rising 0.7% in November for the third consecutive month, largely driven by the increased output of capital goods. This sustained industrial momentum, combined with an improving macroeconomic outlook, lifted investor sentiment in January to its highest level since mid-2025. According to the Centix Research Index, this uptick reflects a significant strengthening of economic expectations across the bloc. On the policy front, the European Union reached a historic milestone by provisionally endorsing a free trade agreement with the Mercosur bloc, comprising Argentina, Bolivia, Brazil, Paraguay, and Uruguay. After 25 years of negotiations, this agreement represents the most ambitious trade deal to date in terms of tariff liberalization, targeting the gradual elimination of duties on over 90% of bilateral trade. Given that trade between the two regions exceeded 111 billion euros in 2024, the pact is expected to fundamentally reshape transcontinental commercial flows. Now our insight into alternative markets. Bridging the gap. Quantitative innovation and the private equity frontier in Europe. The European asset management landscape has reached a significant turning point with the introduction of the Goldman Sachs MSCI World Private Equity Return Tracker UCITS ETF. This new vehicle, overseen by the Specialized Quantitative Investment Strategies (QIS) team, is designed to provide investment results that closely track the MSCI World Private Equity Return Tracker Index. By leveraging the efficiency of an ETF structure, Goldman Sachs is offering a bridge between the traditionally opaque world of private equity and the high-liquidity environment of public markets. The strategic shift toward private markets. For global asset managers, private equity has transitioned from a niche alternative to a fundamental pillar of value creation and portfolio construction. This shift is driven by the historical capacity of private equity to generate superior returns compared to public benchmarks, largely due to longer investment horizons and a hands-on approach to corporate governance. Beyond pure performance, the inclusion of PE-style returns introduces a coinsurance effect, where cash flows that are not perfectly correlated with the broader public market help dampen overall portfolio volatility. Furthermore, the concentrated ownership model typical of private equity significantly mitigates agency costs, ensuring that management incentives are strictly aligned with shareholder interests to maximize operational efficiency. Europe as the epicenter of consolidation. Europe has increasingly become the preferred theater for private equity and leveraged buyout (LBO) activity, occasionally surpassing the United States in deal volume during recent cycles. This prominence is the result of profound structural evolutions, most notably the regulatory integration within the European Union, which has simplified the mechanics of cross-border mergers and acquisitions. We are also witnessing a critical generational transition among Europe's storied family-owned conglomerates, such as the Benetton and Bertelsmann groups, who are now more open to institutional PE partnerships to manage succession and global scaling. This is complemented by the demonstrated ability of European industries, particularly the banking and financial sectors, to achieve greater economies of scale and scope through consolidation than their North American counterparts. Decoding the quantitative investment engine. The innovation of this ETF lies in its systematic, model-based architecture, which replaces discretionary human judgment with algorithms powered by massive datasets. This liquid alternative strategy functions by identifying and extracting the core risk and return drivers of the private equity world, such as specific financial leverage ratios and sector concentrations, and replicating them through a basket of public equities. The process begins with extensive data mining, where macroeconomic statistics and corporate financial statements are processed at a scale and speed that exceeds human capability, allowing for a more precise identification of market anomalies. The subsequent phases of the process involve sophisticated econometric techniques for factor selection, isolating variables like price momentum and implied volatility to determine the optimal timing for asset allocation. To ensure accuracy, the QIS team utilizes a proprietary dataset of private company performance to map these characteristics onto public stocks with similar cash flow stabilities and operating leverage. Finally, the strategy incorporates semantic recognition software to analyze sentiment from news and corporate transcripts. This allows the model to adjust the portfolio in real time based on emerging trends, while simultaneously eliminating the cognitive biases that often hinder traditional investment approaches. Ultimately, the synergy between the robust return profile of private equity and the rigorous execution of quantitative methods offers European investors a sophisticated mechanism for navigating complex market cycles with unprecedented transparency.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.